So, Jeb, you were at Treasury when the financial crisis happened. Now we're looking at the, basically the Band-Aid that's supposed to help prevent this wound from reopening, essentially, in the global financial system. How much of a major step forward is it really?
Well, it's significant. I think everyone knew you're going to have some reforms. And so in order to get to a place of policy certainty and stability, a bill had to be passed. One can question, certainly, though, the speed with which it was passed and the wisdom of some of the major provisions. Have we really solved too big to fail or not? I think remains a contentious issue and an open question. And there are a number of other, obviously, controversial elements to the Dodd-Frank Act, which are still being discussed and litigated today.
All right. Well, two of them, consumer protection and derivatives, really on the firing line. With derivatives specifically, what's the message here? I mean, is moving the trading of derivatives to an exchange so that you can have price discovery more visible, is that enough to help sort of contain the risk?
Well, certainly more transparency in the over-the-counter market, I think, is generally a good thing. I think the big question about the derivatives regulation in the Dodd-Frank Act is really the speed with which, especially the CFTC, has been moving on all of their rulemakings. And I think one of the big messages in today's hearing with the Senate Banking Committee, coming from the Republicans especially, is going to be, slow down and make sure you're coordinating, make sure you're taking adequate time to seek public comment and feedback, make sure that you're considering the broader impact on job creation, on the economy as a whole, and the competitiveness of U.S.-based financial institutions and our financial markets domestically. So that's going to be, I think, the key focus for a lot of Republicans, is really to ask the question, are we moving too fast? Are we coordinating enough? And are we considering the long-run implications of everything we're doing? And let's make sure that we're focusing on quality over speed.
Yeah, that's a sore point because, so much of the crisis was centered around, derivatives and piling on and leverage really being taken on here. Some people say moving towards transparency isn't happening fast enough. When you say issues with job destruction, what are you talking about?
Well, issues with job creation, rather. But the question is it going to be more expensive to hedge your risk exposure, for instance, for commercial end users? Is that going to lead to job destruction? There's a recent study out that suggests that, I think something like the new derivatives regulation may cost the U.S. 130,000 jobs this year, or once implemented, rather. So I think that's the ultimate question. The Dodd-Frank as a whole, and the derivatives section, the title in particular, has implications for the way consumers and especially businesses get credit and manage their risks, and raising the costs of finance generally is inevitably going to have an impact on job creation and the rate at which our economy can grow. Juxtaposed to that concern is concern that we not get in a situation like we had in the financial crisis. And so, riding derivatives that have no margin, that allow for infinite leverage, clearly is a bad idea. I think people can generally agree with that. But it remains very contentious whether derivatives per se were really a cause of the crisis. I think even, we saw this week the Financial Crisis Inquiry Commission's report being debated on Congressional Hill.
Right.
And there was, a great deal of contention on that specific issue.